I was here through Argia's presentation, and I'm going to build upon that. I did want to make a note to the person who asked about looking at the H41, the Fed's consolidated balance sheet, and noting that maybe not all the numbers appeared to be adding up. I would note that there's memo section in the H41 that talks about the committed level of purchases, which is separate from the settlement date. So the H41 is showing the amount that has settled already. And if we have things that are forward settling, they will not show up in the numbers, but you will see them in the memo section of the H41. So I hope that helps. So we're going to talk about implementing monetary policy, how we do what we do. Most of it, the short answer is, it used to be somewhat involved to target the Fed funds rate. Now it's not at all involved. So you know, we have this 0 to 25 range. We have a sort of an infrastructure, if you will, that has rates pretty much trading in that range, and I'll talk about that a little bit. And then we'll talk a little bit about the balance sheet and some of the other things, you know, try and tie it together, what we do with the balance sheet and how that affects the Fed funds rate. So the institutional details, right, of the traditional tools. Tradition here dates all the way back to 2007 and earlier. Anything post August 2007 is decidedly non-traditional. There are aspects of it that were more or less, but traditional to us here is pre-2007. And so the structure that we had then was we had reserve requirements that have been defined, have been set at about 10%. I say about because they're graduated. And so if you're a big bank, it's about 10%. If you're a smaller bank, it may be a little bit less. But we pretty much talk about them at 10%. We had something called a reserve maintenance period. These days, and back in 2007 and starting in the 90s, we have lagged reserve accounting. So that means that your reservable liabilities, as they were measured at some point just ahead of a maintenance period, established what you had to hold in the maintenance period. So you knew coming into a reserve maintenance period, if you were a bank, what you had to hold. Prior to that, we had something called contemporaneous. And that meant you were trying to hold reserves against what your liabilities were on that day, and it was quite complicated. So we've got these two-week reserve maintenance periods. Reserve averaging, it is the average that you've held over that two-week maintenance period. We had a discount, the standing facilities. We had a Lombard facility, the discount rate. When we say discount rate, we typically mean the primary credit facility. There are two other programs, secondary credit, which is another 50 basis points higher, and then seasonal credit, which is really more like agricultural loans that are more very much a kind of a market rate and small in value and volume. But we had the discount window that was 100 basis points above the Fed funds rate target. And then we had no ability to pay interest on reserves. And then we did open market operations. And for us, we did very small treasury purchases designed not to move the markets. And then we did repurchase agreements. So a repo, it's funny, the Federal Reserve Act says we can buy and sell securities. And so our legal documentation and the way we talk about repos is very much a buy and sell kind of transaction. We'll sell you a security today with an agreement to purchase it back in the future at a particular price that implies a rate. The rest of the world knows a repo as a collateralized loan. So we're going to lend money, we're going to get collateral against it. But we're going to talk about repos as purchases and sales, and that's what we used to do. And we did it against direct marketable U.S. Treasuries, TIPS, strips, nominals, bills, notes, whatever, the whole gamut of marketable debt. Then we took agency debt, which would be direct debt of, say, Fannie and Freddie. And then we took agency MBS, which would have been Fannie, Freddie, Ginnie, guaranteed mortgage-backed securities. And so those are three types of collaterals that we would take. We would conduct our open market operations with our primary dealers. There are now 21 primary dealers. There have been as low as 15, as high as mid-40s. We can only purchase securities in any of our programs in the secondary market. And that is all about trying to maintain the independence between the central bank and the sovereign, the Treasury. So the only exception is when we have securities that are maturing. On the day we get the proceeds, we can reinvest those proceeds with Treasury to replace securities. So we would maintain our portfolio size by rolling over maturing securities into new securities. We would grow it by purchasing securities in the secondary market. Our primary dealers, we talked about them. They made markets in Treasury agencies, treasuries for the most part. And we have the rules that were recently, well, I say recently, but I think 2010, updated, the Administration of Relationships with Primary Dealers. It talks about the requirements to be a primary dealer. There are a lot of requirements. There's size, there's compliance programs, and you have to participate in the operations. I will note we are the fiscal agent for the U.S. Treasury. And so in addition to doing the open market operations, we provide some cash management, debt management. We actually conduct their auctions for the Treasury. So when Treasury issues new debt, that auction happens in a different staff here in the New York Fed downstairs on the 9th floor. And if you're a primary dealer, you're a primary dealer for both those auctions of Treasury debt and for the open market operations. And you actually are required in every Treasury auction to bid at, we call it 1 over N, but 1 over the number of dealers. So about 5% of every single Treasury auction you're required to bid. Not take down, but to bid. And that's $4+ trillion a year of Treasury debt issuance. So that's a pretty substantial requirement to be a primary dealer. So banks were required to, still are, but it mattered more then, it was harder to do then, are required to hold a certain amount of balances in their account at the Fed. We call it required operating balances. And that was a function of their reserve requirements, but also we need to recognize the fact that the same account that holds their reserve balances is the account that is part of, they use for the payment system, Fedwire funds and securities transfer. So in essence, that account is like a bank's checking account. There's lots of money coming in and going out. And so they tend to want to hold, especially the larger banks, a minimum amount of balances for liquidity reasons in that account. So we would look at their required reserves, and we would look at the level that they elected to hold in there. And that would help define what it was that banks, the level of reserves that banks wanted. That level of reserves was bounded on 2 sides. It was very punitive if you didn't hold the right level of reserves on average over that 2-week period. On the one hand, if you held too much, there was the opportunity cost of having balances left at the Fed that went uninvested. And when rates were at 5 or 6%, that was much more punitive than where they are today. And if you didn't hold enough, there was a little leeway to make up for it the next period. But if you didn't hold enough, you put your banking license at risk. So it was pretty inelastic demand there. And then we would change the supply. And I'm going to eventually get to the balance sheet and show a little different perspective than Argia's on how our open market operations would affect the Fed funds rate. But as we're looking at the balance sheet, there's a bunch of things on there that we can control. And there's a bunch of things on there that we call autonomous factors that we can't control. Things like banknotes are moving outside of our control. So we would forecast all these things and then figure out what to do to get to a Fed funds rate. So supply and demand curves. Odd for me to be showing you supply and demand curve. Go easy on me, but this is our representation of what would happen if we needed to change the target rate. So the demand curve, as I said, pretty inelastic. It's straight up and down, just above required reserves. But then, as you get above, it sort of flattens out, as you can see down. Here. Here's the level of required reserve. This is the Fed funds rate. This is the level of reserves in the system. Upper bound, and I have purposefully truncated the demand curve at the discount window. Typically, you'd probably see it then, sort of flatline there, but there's some transaction costs, let's say, associated with using the discount window. Not everybody feels so free to use it right now, and so I just decided to cut that off. But so we have the balance sheet, we do open market operations, and there's a certain set level of reserves in the system, and that gives us the Fed funds rate. Because this thing is actually, I had to actually put it on a little bit of a slant so I could show the lines there, but it's pretty much straight up and down. Tiny little changes in reserves can have great big effects on the Fed funds rate, and that's exactly what this is trying to show. The reality is that we did not change the supply of reserves at all when the FOMC would change the target rate from 5.5 to 5.25. We would not have to change a thing in the supply of reserves, because they knew that's where we were going to make them trade, and they would just go right there, and then we didn't have to create an issue. But if rates didn't move, we would push hard against it, and they'd get the message, and then the next time they would probably go there quicker. So again, the difference between theory and the reality of what we were doing, just trying to bridge the gap a little bit there. So I think I've mentioned a bunch of this already, but we would you take a given bank, it had a certain level of reservable liabilities. It's been told by the Fed you have to hold on average $100 in reserves over this 2-week maintenance period. And depending on where we are in that maintenance period, we could see how many reserve balances they had to hold over the remaining piece of the period. And we divide the world of 8,000 depository institutions up into things like large commercial banks and small thrifts and large foreigns, and they're all different trading patterns, but we would ultimately forecast their demand for reserves at the end of the day. Then we would forecast the supply of reserves, the so-called autonomous factors. We have reasonably sophisticated models to forecast how banknotes are going to be moving, how the Treasury's general account, one of the services we provide for Treasuries, essentially having a checking account here for them. We call it the TGA, or the Treasury General Account. They issue debt, money flows into that account, they make payments, it comes out of that account. So at the end of the day, they target a certain level, because if the Treasury is holding balances here, that drains reserves. And so we're forecasting the level of Treasury balances here and a number of other things. So we're forecasting the demand for balances by the banks, we're forecasting the supply of balances at the end of the day as balance sheet factors move around. We then look at where are interest rates this morning, and then we figure out, given that whole thing, stir it up and say we're going to need to do an open market operation of X size this morning. And that would typically be, say, a $5 billion overnight repo. So, unfortunately, it doesn't look like you can see the colors too well, but the letters are all different. So I want to put this, this is the stylized balance sheet that we use. It has pretty much the same thing that Argia had on hers. And I want to note that there are, let's start with the A's. The autonomous factors. So we don't know who's going to need to make a discount window loan at the end of the day, but if we lend someone money, that's going to grow our balance sheet and put an asset on here. Banknotes, we've established that we don't know that, but we're going to model that, and we're going to model the TGA. And there's this thing called the foreign RP pool. We run, like most central banks, we run services for other foreign central banks. We manage several $1 trillion worth of dollar-denominated assets for our foreign central bank customers. One of the services we offer is an overnight investment in repo, and that's what this represents. So we'll model that. We're going to take other assets, other liabilities, and capital, and just say for the short term, let's just assume they're fixed. To the extent we know something's going to move, we'll work that in, but we're just going to assume they're fixed for right now. And so, given these forecasts for everything that's A, we say, what do we have to do to C here? We can affect the size of our portfolio and the repo levels here. And when we adjust those, we let something roll off without replacing it. We buy an additional security. We conduct a repo. The residual, which is the R, is going to be these balances right here. And in the old world, excess balances were, on average, $1.5 billion. Essentially zero in the world of trillions of reserves that we have right now. And so that's what we would do. We forecast all the A's, and then we come up with a plan for the C's that gives us the R that we want. And given the right R, Fed funds are going to trade around the level that they need to trade. We were really, that worked pretty well for us. There's a chart in here somewhere that you'll see. Can we not go backwards? We can't go backwards. Too far. Okay, so just trying to tie the balance sheet, you know, someone who did not do particularly well in accounting, it is amazing to me that I do find the best way to understand the way the central bank work, ours and others, is to get a stylized balance sheet and figure out what any given action and how that's going to flow through. And that's exactly what this is. So, the traditional use. We would establish, you know what, I'm going to maybe do this a little different. I'll probably pay for it later. But we're looking at this, and so we have these tools. We have a portfolio, which we always considered permanent, notwithstanding the fact that we're buying and selling things right now. Remember, this is the traditional use way back in 07. So we would look at these autonomous factors and try and figure out which of these are permanent. If you look at banknotes have a number of patterns to them. There is a permanent growth, Coming into 2007, it was about flatlining. It was almost not growing, and that was going to create other problems. But there's permanent growth to banknotes. There's seasonal growth. Banknotes grow into Christmas holiday and then recede afterwards. They grow into the summer holidays, July 4th, Memorial, Labor Day, and then they shrink thereafter. And then they had changes that happen on every single, on every single day for a variety of reasons, currency shipments, whatever. And so what we would do is divide all the autonomous factors into permanent, transitory, and daily, and then we would offset them by purchasing Treasury securities to offset permanent banknotes. We had, in 2007, a 2-week term repo program. Every Thursday, we would do another 2-week repo. We would establish the size of the term repo program to offset seasonal banknote movement. And then we would conduct fine-tuning operations every day to address the other components that are changing on a daily basis. And that's literally what we did every morning. So hopefully that's more or less what I said here. We sized the portfolio such that it left us room to have a term repo portfolio of a certain size that we could grow and shrink, and then it left a daily operation or a series of daily operations that we could grow and shrink. And so the securities portfolio was purposefully smaller than the level of reserves that we needed from it. And a large part of that has to do with the primary dealers as our counterparties. Primary dealers have a basic business model where they're dealing in securities, and typically they buy it and then they go borrow money to pay for that. And so the dealers are looking to do what we would call a repo. They're looking to give us their collateral that they need financed in exchange for our cash. So our securities portfolio was a little bit smaller than we needed so that we could do the term repos and the regular repos with the primary dealers to make up and get to the reserve levels that we need. We have the ability to do up to 65 business days, which is essentially 3-month term repo. That, by the way, is determined by the authorization that we get from the FOMC, as opposed to some of the other things that are determined by the Federal Reserve Act. Then the outrights. So we would look at this and say, all right, banknotes are growing, and our typical operation size would be $1.25 billion in treasuries, and we would schedule those on a day that no speeches were coming and no FOMC announcements were coming, and we could be very picky and choosy. And then we do this small operation, and rates wouldn't move, and there you go. We just bought another $1.25 billion. But we didn't do those too often. A couple times a month, let's say, is really what we needed to do. Banknotes are growing very fast now, closer to 10%. They've been down as low as 0%. So the operations, you can sort of figure out what that implies for outrights at $1.25 billion apiece. And I think I noted before, we would use reinvestments. We would take the proceeds from maturing securities and reinvest them typically into a similar kind of security. So bonds into bonds, notes into notes, bills into bills, tips into tips, that sort of thing. And then this was the punchline. I'll note that the traditional goes to this point. But you can see the Fed funds effective rate, which is the blue line that bounces around a little bit, very, very close to the target rate. Things got obviously very interesting in August of 2008. Lots and lots of stories in this simple little line here. And then we get down. We went from 1%. We never went to 25 as a point estimate. We went from 1% as a target rate to 0 to 25 basis points. And you can see we've been bouncing in between there without having done a repo since 2008, although we may have bought a security or two. So I think in the early days, in 2007, when we were introducing lots of new programs, and early 2008, running into Bear Stearns in March, we added a lot of things, foreign currency swaps and the term auction facility, and it put a lot of things out there. But we essentially sterilized that. We ran off the term repos, we ran off the repos, we allowed our bill portfolio to mature instead of reinvesting the proceeds. And so we kept excess right around that 0, slightly positive level through that time period. But when Lehman came, the scale of the response needed here swamped our ability to sterilize that. And as you notice those asset and liability charts that Argia had, its total size is flatlined, right? The composition is changing. The permanent portfolio is shrinking and other things are taking over, but it's flatlined. And then you see it just takes off. And when it takes off, reserves obviously take off. We haven't done an NRP since 2008. And the purposes of the outright purchases has changed. I noted before we did them of small enough size so they would not affect market rates. Now we're doing them of large enough size so that it will affect market rates. I think I've already defined agencies and MBS. Current use, loosely defined over the last couple months, the current use of open market operations, we had the maturity extension program where we were removing duration from the market. So we were buying longer term securities, 6 years to 30, and then we were selling the short stuff in our portfolio, 3 months to 3 years, I think. Right, and so the total portfolio size stayed the same, but the duration increased significantly. And I think that was the point of that program. If someone had asked, how do you explain this to someone, what I usually try to do anyway is say that there's, assume for a moment that there's a fixed amount of risk out there, wherever there is. And the more of that risk we can take onto the Fed's balance sheet, the less there is for everybody else. And so as we buy some of these assets up that others were buying, and we've heard some questions about the safe assets, if they can't find that, they're going to have to go find something to replace it. And so they're going to go out either the maturity, they're going to go for longer maturities than they were doing before, or they were going to go out the risk curve and they're going to go for riskier assets than they were doing before. And all of those things help bring all of those rates down. Right? So if there's more people trying to buy a riskier asset, there's more people bidding for it, it's going to bid up the price and bid down the rate. And that's conducive or consistent with the goal to try and tamp down longer term rates. So we did the maturity extension program. That got extended for, I think it was 6 months through till the end of 2013. So we were buying and selling sometimes on the same day. And then we were, this answers the question we were asked before, we were buying 45 billion of treasuries a month. And really that was the amount of treasuries we were purchasing during MEP. And we were selling 45 billion of short term. That program ended, and then we said, well, we're just going to buy. And so we're going to grow the portfolio there. And then at the same time, they added $40 billion of MBS. So that program started in January, and I think this gets back to the question. Those are the ones that have a 3-month, up to 3-month settlement structure. So something bought in January might not settle until, April. But look in the notes, and you'll see what we've committed to purchase. And then the reinvestment of principal payments. This is the pay down. We were talking about, I think, before the presentation started. Agency mortgage-backed securities are securitized mortgages. People pay off their mortgages, they refinance, they sell, whatever it is. You own an MBS and someone pays it down, your principal has just shrunk. And so we have models to forecast that, and early on we did nothing and our portfolio shrank as part of those pay downs. At one point we were buying treasuries when we, the FOMC said we want to get back to an all treasury portfolio, so MBS would pay down, we'd buy treasuries, and where we are right now is that as MBS pays down, we're buying agency MBS to replace it. So those are the open market operations that we're doing right now. So now we fast forward through all the fun of the last 5 years, and we start looking forward and saying, well, someday, hopefully, we're going to exit from this super accommodative policy, and how are we going to do that? And I've just tried to sketch out, and I'm going to talk a little bit about IOER with another fancy little chart, but we can, the tools fall into, in fairness, I suppose I should have another tool up here, is the communication strategy. We've seen that the FOMC has very much bought into the use of communications as a tool, committing to hold things for, low for long and all that sort of stuff. But if you look at the balance sheet, you can shrink the balance sheet, and that would mean selling assets. You can manage the liabilities, and so we had for a period of time something called the Supplemental Financing Program, SFP. Treasury would issue debt, the proceeds of which they kept in a special account at the Fed. That drained reserves, but if you look at our balance sheet, what did it do? It created a new liability called the SFP, and it shrank reserve holdings of banks by the same amount that that grew. That's a classic reserve management tool. The other tool that's been talked about a lot are reverse repos. That would create another line on the liability of reverse repos, and however much that went up, reserve holdings would go down. So that would leave the size of the balance sheet the same, but it would reduce reserves. And of course, the other tool is the interest on reserves. There's an awful lot we could say about the Fed funds market and how it works and how the IOR works. It is not a floor on rates, as anyone who's looked at the Fed fund rates can see. Your typical Fed funds effective rate is 14 basis points these days. IOER, interest on excess reserves, interest on reserves is at 25 basis points. So it's clearly not a floor. And that's a function of the way that market works. Fed funds market is no longer, and hasn't been for some years, a bank-to-bank market. The Federal Reserve Act says we can pay interest on reserves to depository institutions, and yet Regulation D that defines Fed funds allows things like government-sponsored entities and securities firms under certain conditions to sell banks unsecured cash, and those banks can treat it as Fed funds purchased. So we've got a mismatch of definitions. So there's been a lot of talk about, well, why can't you just pay interest to reserves on, to the GSEs? And the short answer has been because that requires regulatory change. You'd have to change the law. So here's the typical example. In the old days, it was one bank had more reserves than it could need, and its alternative was to not sell it and have it go to waste, and it would earn zero on it. And so it would find a bank whose business model left it short of reserves and would lend it the money. That bank would gladly pay for it because it gets the reserves it needs, and that was the Fed funds market. You had some GSEs that were playing in that market, but they were a small amount. And with zero excess, anything a GSE held would actually remove those reserves from the systems, creating banks, paying up, driving the rate up, and then the money that the GSEs held would come back into the system. So it's all a nice sort of self-contained system. But with massive amounts of excess and with this mismatched definition, what you have are GSEs selling funds to folks who can arbitrage the interest on reserves. So I'm a housing GSE, I've got $100, I can keep it and earn nothing, or I can find a bank who's willing to pay me 12 basis points for it, or 14, since that's where the effective is yesterday. Pay me 14 basis points, so I'm now making 14 as opposed to 0. That bank paid 14 for it, and in a risk-free arbitrage is going to hold it at the Fed and earn 25. And that's the essence of the Fed funds market today. It still tracks very closely to related money markets. As you saw in some of the charts, the Eurodollar market, CD, CP, these things all track very closely together. But it would be a misnomer to call Fed funds an interbank market these days. And so what does that mean? There's a question about whether the Fed funds rates are a spread to IOER or whether they are more of a split the difference between 0 and IOER. And it matters a lot if you want to raise interest rates 10 basis points, because where market rates are spread to IOER, you raise IOER 10 basis points, market rates come up 10 basis points. Where it's a split the difference between 0 and IOER, you need to raise IOER 20 basis points in order to achieve a 10 basis point increase in rates. We've done a lot of studies, we've done a lot of looking at this. We do not have a whole lot of history here in the States with this data and the high level of excess. Our sense is that it's more of a spread, potentially much more than a spread. But again, I think I have to say the caveat, that's myself and some of my colleagues who've been looking at this as opposed to any sort of official Fed position. But our sense is that it's probably spread or spread-like. But that has its implications. So here's my second little chart. You've got a classic corridor system, except that rates are trading outside the corridor by design, you would have to say. The discount rate, the lumbar facility up top in red, the redeposit facility rate, or the IOER rate down in the bottom on blue, and then you've got a Fed funds rate, the solid line on the bottom there. Same supply and demand curves. But now if you wanted to raise interest rates, you would raise IOER, so that goes to the blue dotted line. That would change the demand curve up, and you'd get the new Fed funds rate. Don't take anything from the proportions or anything about what that means. This is just a stylized version of it.